Hi, hello everyone. This is Yuvraj, working as an assistant professor in Department of Commerce, DM, it is Digital Marketing and Data Mining at Dr. SNS Rajalakshmi College of Arts and Science, it is in Coimbatore. Today we are going to see about a risk reporting. So today we are going to see about a risk reporting. So what is mean risk reporting? Banking risk overview and frameworks. So what are the risks we have in the bank? We are going to see about the overview and what are the frameworks we are going to see about it. Introduction. Effective reporting of banking risk is critical for maintaining financial stability and regulatory compliance. This process involves identifying various types of risk, understanding their sources, and communicating this information clearly within the institution and to external stakeholders. Accurate risk reporting supports informed decision making and risk mitigation strategies. Informed decision making and risk mitigation strategy. The next is risk identification in banking. Risk identification in banking. So what it is? Types of banking risk. So banking risk includes credit risk, market risk, operational risk, liquidity risk, and legal risk. Each type affects the bank's financial health differently. Understanding these risks allows institutions to prioritize mitigations effects and allocate capital accordingly, maintaining reliance against potential losses. Resilience against potential losses. It is a types of banking. Risk sources and triggers. So what are the triggers and risk sources? Risk stem from internal factors like management practices and external factors such as market volatility or regulatory changes. Trigger includes economic downturns, technological failures, fraud, or geopolitical events. Identifying these triggers early is essential for protective risk management and minimizing impact. This is a risk sources and triggers. Risk assessment techniques. So what is risk assessment techniques? Risk assessment techniques in banking includes quantitative methods like value at risk and stress testing, as well as qualitative assessments such as expert judgment and scenario analysis. These tools helps measures the potential impact and probability of risks, enabling banks to prioritize and implement effect controls to mitigate financial exposure. Now we are going to move about a risk reporting framework. So what are the risk reporting frameworks in this? Regulatory requirements and standards. Banks must comply with regulations such as BASE 3 and local supervisory guidelines. These frameworks define minimum capital requirements and set standards for transparency and consistency in risk reporting. Compliance ensure the institution's credibility and strengthens market confidence. Now it is an internal reporting process. So what is internal reporting process? Internal risk reporting involves timely and accurate data consolidated from different departments. It supports strategic decision making by providing management with insight into risk exposure, trends, and compliance status, enabling protective risk management. Risk management. Effective communication ensures that risk information is clearly understood by all stakeholders, including regulators, executives, and investors. Transparency fosters trust and supports collaborative risk mitigation efforts across the organization. It is risk communication and stakeholder engagement. Now, it is in conclusion. Robust reporting of banking risk is essential for maintaining financial stability and regulatory compliance. Integrating comprehensive risk identification, assessment, and communication frameworks ensure institutions can manage uncertainty effectively and protect their assessment while meeting stakeholder expectations. This is the conclusions, and thank you.